This is Tim Park Breakdown, and today we're breaking down Deckers Brands, ticker symbol DECK. Deckers is a large cap stock, and just looking at their main competitors, it would be Nike, On Holdings, and Skechers. They do not pay dividend, and they are in the S&P 500. Looking at the 52-week high and low, it made a new 52-week low this previous week. If it is a bad company, it can definitely go lower. Don't get fooled by the price. You don't want to catch a falling knife here. On the other hand, if you believe that the market is overreacting and you believe in the fundamentals of the company, there's a lot of room for the stock to go on a run on the upside. Deckers Brands is a U.S.-based footwear and apparel company headquartered in California. Founded in 1973, the company designs, markets, and distributes premium lifestyle and performance products under well-known brand names including UGG, Hoka, and Teva. Deckers is best known for its UGG boots and the rapidly growing Hoka running shoes, both of which have contributed to the company's strong financial performance and global brand recognition. The company operates through both wholesale and direct-to-consumer channels and emphasizes selective distribution and innovation to maintain brand values. Summing it up, Deckers Brand is a holding company for footwear companies. UGG was acquired in 1995 for $14.6 million. And then in the year 2000, the company got a shout out from Oprah. This led to $100 million in sales in the year 2004, which kickstarted the growth of the company. In the fourth quarter alone, UGG did $1.24 billion in sales. This was up 16.1% from the same quarter last year. Teva are just outdoor sandals, and they were the first major acquisition for $62 million in 2002. This last quarter, they generated $24.1 million in sales, down 16.6% from the same quarter last year. Hoka was the game-changing acquisition for the company, where they paid $1.1 million for the brand that now generates over $1 billion a year in sales. They generated $530 million in this last quarter, up 23.7% from the same quarter last year. Stefano Caroti graduated from Middlebury College, a college in Vermont, with a bachelor's degree. He began his career at Nike in Italy as their director of marketing, then worked as a general manager in Germany. He then moved to Puma as their chief commercial officer and served on their board. After this, he moved to Deckers Brands, where he spent 9 years with the company before he became CEO in August of 2024. With previous high roles at major shoe companies, Stefano is now CEO of a major brand. At the age of 60, the biggest strength he brings is experience. He has a strong vision for long-term growth, driving the business and international growth. I graphed Q1 and Q3 of their fiscal calendar year. Q3 is October, November, December, their holiday season. Q1 is April, May, June, a regular quarter. You can see how they are a cyclical business, but are growing year on year. Last conference call, management was talking how they strive for growth in the teens every year for years to come. Looking at the balance sheet, not just does it show how healthy they are as a company, that alone is a great thing to take away from a balance sheet. But looking at how liquid they are, to be more specific, they have $2.24 billion in cash. And for a company that has acquired companies before and made them big, it could open up for a potential future acquisition. Stefano has worked in Italy and Germany and is fluent in both languages, so they could grow international as well, thanks to his connections he has in Europe. In fact, he said international growth grew 28% year over year. Another really good catalyst is their diversified portfolio with running shoes for Hoka, Teva sandals, and comfort with UGG. And the last great positive catalyst that cannot get underseen is how good their statements are. The revenue growth has been great quarter after quarter, and their balance sheet is as strong as you could ask for a company to have. A strong balance sheet like that will make sure that you won't have to worry if they have a slow year because they can afford it. This will also let them continue to think in the long term. You can see here on the graph on the right where they have their products being made, and this exposes them to the new tariffs the USA is imposing. Another thing to watch out for is to make sure they are not a hype-based company. The biggest risk you take is if UGG is a hype-based shoe, sales would fall off and the company would struggle. And with Hoka competing with a giant like Nike, they must continue to innovate if they want sales to continue to increase. Lastly, the stock volatility is something you must watch out for. In the short term, investors are still working on valuing this stock. It's been on a free fall all year, and if you're worried about the short term, no one knows just how much more this can fall or if this is the bottom. This is Deckers Brands, ticker symbol DECK. Comment down below what stock you want to see reviewed next.